There's all this inflation, and of course you've heard the rumors of an approaching recession. Plus, this is underneath the umbrella of all of this admittedly unpayable debt, much of which is owed to the weakest among us. I'm talking about pensioners. There will be pension shortfalls. And this downward market lately is certainly not helping out the pension situation or most investor situations at all. Now, add to all of this that I believe we're just in the very beginning, the very early stages of what will be a very significant decline in real estate prices. So I imagine that you have a question. It's the same question that I'm asking. It's the same question most of us are asking. I believe that you probably want to know, when does all of this get better? When does it end? When do you get to go out in public and not see all these negative headlines on the newspaper or all these red arrows across the screen when you turn on the news? When does it get better? Well, I've thought about this a lot, actually, and I came up with 6 things I think have to happen before things turn around. But I also want to indicate that when things do turn around, I want to make it clear that that could be one of the most significant buying opportunities for investors ever. So we'll talk about that exactly in this video. Whenever things do bounce, there are going to be tremendous opportunities, and you want to be set up ahead of time to get the benefit of all of that rebound. And based on recent activity in the stock market, you might think it's like catching a falling knife. You tell me, is this a falling knife? Dow Jones Industrial Average. This is the NASDAQ. This is the S&P 500. This is all leading me into my newest stage of my premise, where the first part of the premise was that everything was going to come down together. And now that that has begun, the next stage of the premise is actually much more heavy, so to speak, because it's about the downward drift of the entire economy continuing. And everything's pointing to the fact that this will only continue. And I really hope that, I was hoping my premise wouldn't be right to this point. Now that it is, and I start opening up my mind to maybe I'm going to turn out to be correct in all of this, it's not good, okay? I'm not trying to whatever. Listen to this. There will be more deaths. There will be more deaths from suicide if things go as I expect that they will. There will be more domestic abuse. There will be more divorces. There will be more homelessness, tremendous food insecurity, layoffs, shoestring budgets, delinquencies, bankruptcies, and even evictions. It'll get bad and it's serious, and I always want to remind you guys what we're talking about here, because we're not playing around here. This is what we're doing. We're going to try and do the best we can in this clown show that we're trying to navigate through. We are on uncharted waters. There's never been something like this. And I'm not saying it's different this time. That's the 4 most dangerous words in the stock market. It's different this time. It's not different. It's just uncharted waters. We don't know. There's nothing to compare it to. But the 6 things that I think need to happen before this overall market actually rebounds strongly and sustainably. I believe that we will not get out of this downward drift until the recession has come and gone, fully passed, showed up and went away. I also don't think that we'll get out of this until there's been somewhat of a deleveraging. If you have a mortgage and you owe a certain amount of money on that, or if you have a stockbroker account and they let you trade with more money than you actually put into the account, that's the leverage. Those amounts are maxed out, and as the markets fall, the brokers will be forcing people to relinquish some of that leverage. But overall, how much leverage, how much debt you have right now? A year from now, 6 months from now even, it will be lower. That's what I'm talking about. All of this deleveraging will be happening. And I think some of that has to start in earnest before we get out of this downward slide. I also don't think that we'll get out of this until the Federal Reserve has finished raising interest rates. So whether you wait for a pivot or they just get to the point where they say that's what we wanted to do, and then inflation comes down, they start lowering rates. At that point, that's what's going to have to happen before we get out of this downward drift. I also don't think we'll get out of this until all the delinquencies and bankruptcies have run wild through most of the economy. I'd also say that we'll be in a downward trend until we get at least 5% unemployment or more. And lastly, not until after stocks have overcorrected. I told you it's a pendulum. They go from overvaluation to undervaluation. I think we'll be in a downward slide until stocks bottom when they overcorrect, hopefully a capitulation point. And I'm telling you that would actually be one of the best buying opportunities ever, especially for inexperienced investors. That's where you go, and all you have to do is take $1,000 and you put it on IBM, General Electric. You just get in at that point, Apple, whatever company you want. You get in at that point and you just ignore it and let it grow for decades, in my opinion. So all those 6 things, including a capitulation point in stocks, then we'll get out of this bear market in a big, big way. But you have to be fast because it may bounce and go fast, or it may take decades before we get out of this. That was the point of my video about, is this a global recession or global depression? And I know that video was long, 49 minutes. So if you only watched the first 15 minutes or so, go back and watch another part. That video I was proud of because I kept the knowledge bombs and the energy level up equivalently throughout the entire 49 minutes. I was proud of that video. So anyways, in this video, make sure you get to the part with Jeremy Siegel from the Wharton Business School. I put in a really awesome clip that he said, and I really want you to see it. I love this guy. But there's 2 things in this video we're going to talk about. I look at numerous different news sources, and I thought about pulling some certain things out when I see something that I think you need to see. And a lot of the stuff I pulled out, I realized in this video, a lot of stuff I pulled out from different mass market media stuff, a lot of it is actually all the stuff that we were talking about months ago, year ago. So watch these clips and just think about how it's the growth of awareness, where you were already aware of it, but nobody else was. And then you get to this point and now it's on the mass market media and everybody's getting to know what you already knew months ago. So I thought it was kind of fun to watch. You tell me. And the other thing in this video I'm going to show you is a consolidation in gold mining stocks right now that's significant and relevant, that I absolutely have to show you this on some charts here. We'll look at Barrick Gold, IM Gold, Newmont Mining, but this is just a sample of 3 of them. A lot of gold mining stocks are all showing this exact same consolidation pattern, which is very good for investors if this breaks out to the upside. And I know that you know that anything we say anywhere and in this video, it's not intended as personalized trading advice for you. So let me show you one of these media clips where they're just telling you stuff that you knew months ago.
And Good Friday evening, we'll have more on that state of emergency in Florida, but we want to start with that brutal day on Wall Street, capped with another market sell-off. There are growing concerns of a recession on a global scale.
Notice how he says recession on a global scale. You see, they're starting to get it. They're catching up with us. And think of it from the aspect of social awareness. You want to see a big growth in social awareness from where it is now to where it's going to be 6 months, 12 months from now? Look at headlines in real estate.
Take a look. The Dow notching a new low for the year, closing below 30,000 for the first time since mid-June. All the major averages seen their 5th negative week in the last 6. It comes 2 days after the Fed raised interest rates by 75 basis points again and suggested they'll do the same in November.
I'll tell you where there's no awareness. The pension crisis that we're about to face. No one's talking about it. I think people don't like to think about kind of stuff like this, so they just put it out of their mind or something. It's math. That'll show you a massive and sudden growth in awareness almost overnight. I don't know when it's going to start, but hopefully the sooner the better.
Today, the S&P 500 was already in a bear market, and by the way, closed today at its lowest level since December 2020. Not a time frame you want to compare it against.
Always think of interest rates as a tool that is used to punish an economy, to slow it down. And in this case, it's the Federal Reserve. It's trying to help the Federal Reserve and our intractable leadership to sweep all the mistakes that they are making under the rug. It makes it easier to deal with all the errors they've made if interest rates are higher and the inflation rate comes down on its own and if the economy slows down. But who is that not good for? Anyone who has some kind of stake in the economy will be one of the people who's taking a little bit of a bath on that. Well, what am I talking about when I'm saying the mistakes they've made? Oh, I don't know. For example, keeping rates near zero for far too long, absolutely gluttonous monetary creation, not only joining sometimes leading the currencies around the world in a race to the bottom, as well as all of their dishonest and ill-informed and misleading public statements. And it's not just the United States. Economies are being punished right now all over the world. Indonesia, Mexico, Argentina, India, South Africa, United States, Germany. It goes on and on and on. Everyone was euphoric and pigging out worldwide, and now everyone is tightening their belts. It all happens together. It's not one country goes one way, the other country goes the other. Sometimes, but in general, countries are like flocks of birds. And now, as I always tell you, global economies right now are more interconnected than ever, and they're highly connected. So whatever happens overseas even, it's going to matter. That's why you have to watch everything. So speaking of that, check out this.
Overseas, the British pound hitting a 3-decade low against the US dollar as a new economic plan in the UK rattled European markets. So is all of this signaling even bigger problems ahead? We want to get right to one.
All right. Jeremy Siegel, I love this clip. This is awesome. Check this out.
Listen, the Fed has just, executed the last 2 years one of the biggest policy mistakes in the 110-year history of the Fed by staying so easy when everything was booming and pointing to, my God, inflation is going to be a terrible problem.
And we need to get into the consolidation of gold mining stocks, which I need to show you. But first, I wonder if you agree with this comment.
The only thing worse than high inflation will be high inflation alongside job losses, which could come as the Fed makes the borrowing costs more expensive. That's something that is definitely a concern.
You see what he said there? Which could come as the Fed makes the borrowing costs more expensive. Everyone's softening their language so much that we don't even know what we're actually dealing with. We're not looking at things directly in the face. Instead of saying, which could come as the Fed makes borrowing costs more expensive, what he should have said is, which will come as the Fed. And a lot of that involves moving into this recession, which means more bankruptcies, fewer municipal services because the municipalities have lower tax revenues, and they already have trouble balancing their budgets now. Layoffs will increase, of course, meaning unemployment rates will also rise. Inflation itself will come down organically, and there will be inventory gluts like I told you about in previous videos. There's going to be significant inventory gluts. And I just saw a few stores, companies like Target, for example, they're just extending the holiday shopping season because they have so much inventory that they have to push onto you because they overstocked their inventory. That's why you're going to see all these blowout sales over the holiday season this year. Everything must go. Food and fuel prices will come down. Gasoline prices will come down. And of course, real estate prices are going to slide lower. There will be increases in fraud and delinquencies. Delinquency is when you can't pay what you owe. But fraud, when you go in to get a loan, for example, and you lie on how much money you make, that counts as fraud. There's always a spike in fraud rates before the final downward slide begins. Families and businesses will be operating under shoestring budgets. Small business owners are going to be one of the most negatively affected groups. Retail space will be very cheap, and there will be an increase in civil unrest. However you want to say it, just basically your quality of life will come down because of the recession. But one thing you can be certain of in any time frame, in any nation, anywhere in the world, politicians will always make bad decisions. Case in point.
A big story, Tom, today is certainly the chancellor coming out in that newly formed government announcing that they would like to pursue tax cuts during a time of double-digit inflation in that country. The market reception not good at all with it.
Those tax cuts will be obviously inflationary. I put this in not about the tax cuts, not about the inflation, not about Europe. I put this in to show you what politicians and our leaders they do that are going to cost you because they don't know that they're hurting you. They think they're helping you. But anyways, let's take it back here at home. Watch what he says in this clip about retirement plans, 401ks, pensions.
People are going to be looking at their 401ks going, what has happened.
Yeah, well, they've seen a massive downdraft in their 401ks, and the end is not necessarily in sight because, as Brian pointed out, the Federal Reserve is going to continue raising rates until we get to about 4.5% on the Fed funds rate. That's a ways from here. So a couple more rate hikes, and rate hikes put pressure on stocks. Investors have been bailing out to the dollar and government bonds.
One of the things that happened with a lot of the pension funds that are out there right now, they switched the fine print in your contract that if the stock market does well, everybody parties. Stock market does bad, it's on your shoulders. And a lot of these pension funds, especially the municipality ones, they earmark a certain gain from the investments in the stock market every year. So they expect it, is not the right word, they assume it. They assume that they'll get, we say, 6% a year. Some of them is 8%. So what happens when the stock market comes down 20%? Where's that 6% going to come from? Some of these pension funds are asking for increased contributions. Others have asked pensioners to accept lower payments, both of which are forms of default. Plus, you have all the inflation in the real world on the street right now. So you step out your door, you're paying more for stuff. So if you're a pensioner, you've got all of these different hits that you're going to be taking. And the other day, after years of looking for it, I saw the first, I guess I'll call it legitimate headline talking about sunsetting Social Security. It's the first one, that's where it starts. You'll hear more and more about sunsetting or shutting down or just defaulting on Social Security because we already admit the money's not there. It's a matter of somebody coming out and saying, now what are we going to do about that? That's where it just stops. No one wants to take the next step. We just know there's no money there and that it's owed to a bunch of people that need it to eat food and live and survive and exist, and it's their money and they earned it and they put that money in there over years of working in the economy. And now because we have a bunch of donkeys running the show, you are going to lose a bunch of your investment dollars with no involvement or knowledge on your part. And a lot of baby boomers, going back to demographics here, we got a big portion of the population that is now just entering retirement age. When you get to retirement age, if you have money in things like retirement savings, a lot of the time with the government, you have to take a certain percentage of it out every year. What they're doing is when you take the money out, you're actualizing the gain or loss. You're taking that money that was never taxed and they're taking their taxes on it. They're forcing you to take your money out of your retirement, put it wherever you want, but then that way they can take their slice of it as it passes through. So a lot of retirees, a massive portion of the population, baby boomers, are going to be continually forced more and more to sell their retirement investments, mostly stocks. And we'll get to the gold consolidation right after this last clip that I have to show you.
The big difference this time, the Fed is raising rates as the economy is slowing. That is putting pressure on risky assets like stocks, like cryptocurrencies. That's what we're feeling now. We'll get through this eventually, but it could take 6 to 12 months.
Wrong. I'm talking about his last 8 words. That's wrong. The rest of it, though, is spot on, especially the part about the Federal Reserve raising interest rates in a declining economy. Here you can see gold stocks are range bound. This is Barrick Gold. This is IAM Gold. All of these stocks and a lot of other gold mining stocks have the exact same chart. This is Newmont Mining. What you're looking at here is a consolidation period. The longer this goes, the more powerful the move out of the consolidation will be. And I believe that we're at a bottom, not a top. It's not going to break strongly lower. I don't believe that. That's my opinion. I've been wrong before. But you don't need to worry about gold. You don't need to worry about gold. It'll be fine. The gold mining stocks will be fine. You just have to wait. I thought that gold would do a lot better by now than it has. But just wait. It's stronger than ever. It's just gearing up right now to potentially make a very significant upward move soon. The longer the consolidation, the tighter the range, the more power is being pushed into the spring. And the consolidation range doesn't get tighter or smaller. If it starts off pretty big, it'll stay that big for the entire time it's consolidating. But ideally, you want to see a really tight consolidation range for a really extended period of time. The tighter and the longer it goes, the more powerful and profitable and rewarding the move higher out of that range will be. And it'll just be one day, it'll just go whenever it's done consolidating. So none of that's trading advice. The next video is about, and I'm finally getting to it, the 8 things to do about either the global recession or the global depression. We're having one or the other of those two. What do you do about it? 8 things. Bang, bang, bang. You're going to love it.